Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. So thankful to have you with us here post this Christmas week and heading into the new year. We'll take a look at a few of the final topics for 2023, and I look forward to picking it back up with you next year. So we're going to talk about M&A activity. We're going to talk about China and their lead in the EV space, and not just in a little way, but in a big way. And then Andrew's going to wrap it up with some technical points on industry breadth and taking a look at the difference between large caps and small caps. So let's dig right into mergers and acquisitions activity. That's what the M&A stands for there. So here you can look at global deal values. We are as low as we were back in 2013. So a full 10 year later. So you have economic growth, you've got inflation. All these things should lead to higher and higher deal values, but we fell off in a big way. 2022 was noticeably weak because everything was weak in 2022, but there was not a rebound in this year, largely due to the fact that interest rates were elevated and continue to rise through the first part of this year. So this will be one of the key factors, in my opinion, going forward. Of course, one of the biggest impacts here is going to be Wall Street bonuses, things like that, but it has broader impact as well in terms of which companies hit the market, which ones come off the market, and how much money is left in private equity. All those factors impacted by how much we're able to actually have here. And I think ultimately there's a large backlog of deal activity that could unfold should we see rates fall going into next year. So that's mergers and acquisitions. Certainly something we'll be looking for in our core plus solutions and anything tied to private markets. So take a look at the EV market. This is just one of those bigger take a step back themes. EVs, of course, are just an ever-growing part of the background, whether it's energy infrastructure and investment for utilities, to how Detroit is doing versus the rest of the world and Tesla, et cetera. All eyes really point to China here, and just in terms of how much they are in charge of this theme. So the first on the left panel here, we start at the bottom and just take a look at 2015. There weren't quite any charging connectors around the world. That bottom scale points you to 0, 1, 2, and then ultimately for this year, 2023, the top row there, we crossed 3 million public connectors. And as you can see, China has led the way there. As we've crossed the 3 million, China is actually a whopping 68% of all of those, connecting not just the big major cities, but onto the more rural mainland as well. So they've really invested heavily in infrastructure, which leads to the right panel, which is a projection for total fuel consumption in that country. So with all those charging connectors in place and being wildly popular, especially among the younger Chinese, it is expected that the fuel demand in China will continue to wane. So again, one of those bigger themes that will have impact not just on Detroit, but on fuel demand and so many other things as we cross over to 2024 and beyond. So that's from my side. Andrew, I'd like for you to unpack and see what things we're saying technically as we wrap up the year.
Thanks, Adam. So one of the topics that we always are discussing in our allocation meeting each week, and something I've talked a lot about this year in these weekly Market Carver videos, is looking under the hood of the market, looking at the breadth of the market, which is just a fancy way of saying participation. When we're in the in and out trend, we want to see a lot of stocks, a lot of sectors, a lot of industries rising along with the broad indices. And the same thing when we're in a downtrend, we often will see a lot of stocks, sectors, and industries also going down. And that's where we call that participation. Or they're participating on the upside or they're participating on the downside. Now the market's been bottomed back in several months ago, and the market's been recovering. We're just about back to year-to-date highs. Several measures of the market actually are already hitting new highs. We want to start seeing the broadening out, more stocks, more industries, more sectors doing the same. And that's exactly what we're seeing. This first chart we're going to look at in the bottom panel is the percent of industries making new 52-week lows. We can see right now, no industry right now is making a 52-week low. Meanwhile, in the middle panel is how many are making 52-week highs. How many industries are rising along with the market? And that gauge broke above 20% and actually exceeded the level we saw last summer. That's significant because the market has recently just been able to break back above its summer high as well. So we are seeing the broadening out. We're seeing more participation from different corners of the market rising along with the market, and that's exactly what we want to see. If we look back in the left part of this chart, you can see we started seeing less and less industries. We started seeing lower highs and lower highs and lower highs when the market peaked back in January 2022. And then towards the bottom, you can see at the bottom panel, we actually started seeing less stocks, less industries making 52-week lows. So this is a great way for us to gauge the health or the weakness of the overall market based off how many large cap industries are rising or falling. And right now we're seeing a good amount of strength, and that's very encouraging for the bulls. The last chart I want to share with you is another topic we've discussed a lot on the Market Carver, and we talk about almost every week in our allocation meeting, is looking at the relationship between the largest stocks and the smallest stocks. One of the themes throughout 2023 has been the leadership from the Magnificent Seven or the FANG names. They get different titles, but essentially the largest stocks in the market. Think Apple, Google, Microsoft, Google, Tesla. The biggest stocks in the world, the biggest stocks in the US had really been the main drivers, kind of dragging everyone else along for the bulk of 2023. And that was okay as long as those trends stayed positive. It was a concern, but it wasn't a huge concern that we weren't seeing a lot of other stocks rising at the same level of strength. And so that's what we can see in this chart. As this line goes higher, the S&P 100, the largest stocks in the market, versus a reverse weighting of the S&P. So it's essentially looking at the largest stocks versus the smallest stocks in the S&P 500. When this line is going higher, it's telling us that the largest stocks, the mega caps, the Apples, Microsoft, Googles, that they're the ones that are leading things higher. But if we notice that trend starts to change around November, the line starts to go down. That tells us that the mega cap stocks, those big names, aren't showing the same level of strength. Instead, we're starting to see leadership come from the smaller cap stocks in the S&P 500. And that's a positive sign. That's telling us that the market's able to continue to go higher and not being required, and not a requirement of the biggest stocks to drive it to do so. In fact, we can start seeing more stocks start to move the market up, even though if it's not having leadership from Apple and Microsoft and those mega cap, the Magnificent Seven names. And so this very much fits another topic we talk a lot about is seasonality. Historically, towards the end of the year, we do start to see smaller cap stocks start to show strength. And so we are following that seasonal roadmap that this year has done a very good job of doing so far, and it's continuing into year end. And it's something we're continuing to be encouraged by. It's something that we have made portfolio changes to help try to capture, adjusting our sales, so to speak, to get some of that strength, some of that wind behind us. And so we can participate in that rotation from the biggest companies to maybe some of the smaller companies and try to get some of the gains within our core equity models as well. And that will be something we look for in 2024 to see if that type of rotation continues and we start seeing more strength coming from a part of the market that frankly was pretty quiet for the bulk of this year.
Excellent. It's so good to have some refreshing news here, and that's just been a great end of the year, and hopefully we carry that deep into next year. But as always, of course, we stand at the ready to adjust if it doesn't happen to be that way. But for now, I'd love to have that refreshing stuff coming from you. So thank you, Andrew. Thank you to all of you for giving us your time here. As always, we give you a reminder, give us a call if we can be of service, 800-928-4001, or scan the QR code and book your appointment online. So once again, everybody, please have a happy new year and a great weekend.